You've seen a huge bifurcation of valuation in the last, call it 6 or 7 years. So what has predominantly happened is valuations in the US have risen quite substantially. People perceive this to be just because of the Magnificent Seven, but actually the reality is valuations across all sectors in the US have increased quite substantially in, call it the last 5 or 7 years. Where we see value opportunities right now are in companies that are outside the US. Europe is one area where we definitely do see more opportunities for buying good companies with attractive valuations. And actually Japan as well is another area where we've been able to find a couple of ideas more recently. That's sort of how I would distinguish between valuation opportunities by region. For the quality of the businesses, we're seeing better opportunities in Europe and Japan, for example. I would say there's sort of 2 big risks that we would be looking out for. I think the first one is super obvious given the setup for where we are in the year, and that's the geopolitical risk. How to handicap that is a lot harder because we don't know what the direction of travel is going to be along these risks. So I think that's something that we are mindful of, but it's not something that we can really control. I think the second risk that we would see that's potentially more interesting is around this valuation argument as to where you have pockets of attractively valued companies where perhaps the risk is a bit lower, but equally where you have higher valuation companies. I mentioned the US. That's maybe from a regional perspective, but it's not just necessarily the US. It's also things that are in the AI bubble, if you will, have also seen valuations expand as well. So there's some regional valuation risk, I would say, and then there's probably some sectoral risk as well. One of the sectors that we like, or still like actually, so we've owned this sector for a while, but we continue to like it even now, is the insurance sector. Specifically, it's the non-life insurance, property and casualty insurance. So this is things like motor insurance or commercial insurance. It's a recurring revenue purchase. Oftentimes it's required by law. The profit cycle of these companies are a little bit more idiosyncratic, so it's less macro dependent and more company specific. So that's a sector that, a subsector if you will, that we like right now. Maybe starting from a fund perspective, I would say that individual investors should be really, really focused on not just what the return of a fund is, but the kind of risk the fund is taking to deliver that return. From our perspective, I think that idea of delivering attractive risk-adjusted returns, return with lower volatility or returns with lower drawdowns, that's something that I think is going to prove to be more important. You have the potential risks around the geopolitical risks that I mentioned, or even the valuation risks that you see in pockets as well. So I'd be focusing on the drawdown and having lower drawdowns right now in the market. Our turnover is quite low. We don't usually make that many investments in a year compared to perhaps a lot of other portfolios. But we did make one in April. So in the turmoil of Donald Trump's sort of tariff issues that he did put through, a lot of the stocks globally, people perceived to be significantly affected, did have significant drawdowns. The last company we bought was a company called Shin-Etsu in Japan. It's a PVC manufacturer and a wafer manufacturer for the semiconductor industry. The stock had fallen very substantially. We knew it was a high quality company and we thought it was a good entry point to be able to buy a company that we think has good growth prospects into the future without an effect to the fundamentals because of these volatility in its stock price.